Hello guys, welcome to video number 6. My name is Tevin with theorangecompound.com. This video we're going to understand risk management. Let's go ahead and get started. What is risk? For traders, risk refers to the potential of experiencing financial losses or adverse outcomes in their investments due to market uncertainties or unexpected events. So what are you willing to lose in the market? Are you willing to lose $10, $100, $1,000, or more? What is risk management? Risk management reduces losses and safeguards traders' accounts from complete depletion. It is implemented to address the occurrence of losses experienced by traders. Employing a strategic and objective approach, utilizing stop orders, profit taking, protective puts, is an intelligent method to remain actively involved in a trading game. So risk management really is the foundation for keeping your account. For example, if you had $100 and you risk $90 for a trade, if you lose that trade, it is most likely that you're going to lose your account. Whereas if you had a $100 account and you risk $10, you would be able to take 10 trades before you lose your account. Risk management is extremely important. What is reward? In financial markets, reward refers to the gains derived from a trade or investment, such as potential profit. People will often refer to your take profit as your reward. So whenever you're in a trade and you're setting up things and you're looking, okay, what is the potential reward? How much can I make off of this trade? So very similar to our previous example, if you had a $100 account and you risk $10 in the trade, if you go for a 1 risk to reward ratio trade, if you won the trade, you would make $10, and if you lost the trade, you would lose $10. Position sizing for Forex. In Forex trading, position size refers to the total number of units of a currency pair that a trader invests in, representing the size of the purchase trade. So I have 2 examples down here. I have an $1,000 account, risking 1% equals $10 at risk for the trade. The trade size for that position would be 0.01 lots of GBP USD. Now GBP USD is just a pair that you can trade. There's so many different currency pairs you can trade in Forex. I'll make sure to have a whole nother video series about Forex, but this is just for an example. The second example is a $10,000 account, risking 2%, $200 at risk for that trade, equals a trade size of 0.20 lots of GBP USD. If you look to the right here, you'll see a screenshot of babypips.com. This is called their position sizing calculator. It allows you to input your account balance, the amount of risk that you would like to risk in that trade, your stop loss in pips, and then you choose the currency pair. Now, what you would enter when placing the trade, you wouldn't enter the micro lots or the mini lots, you would enter the standard lots. That's what you would input. So if you had a $100 or $1,000 account, you wanted to risk 1% with a 100 pip stop loss, you would do 0.01 as your trade entry. Position sizing for futures. The placement of your stop and the percentage or dollar amount of your account that you're prepared to risk in the trade is really, really important. A tick, which is very, very important for futures, represents any change in the price of a security. For example, if you have a $1,000 account risking 1%, you would have $10 at risk for a trade. If you had a $10,000 account risking 2%, you would have $200 at risk for a trade. What is a stop loss? A stop loss point is the price at which a trader sells a stock, incurring a loss on the trade. This typically occurs when a trade does not unfold as anticipated by the trader. So a stop loss is basically the maximum amount of money that you're willing to lose in a trade. I have an example right here for the NASDAQ futures. Each contract for the NASDAQ futures is $5 per tick. If you're willing to only risk $100 total, then the maximum your stop loss can be is 20 ticks. You can set your take profit to 20 ticks, which would give you a 1-to-1 risk reward ratio. That would mean if you win this trade, you would make $100. And if you lost this trade, you would lose $100. Futures trade with stop loss and take profit. If you see SL or TP, that's kind of like an abbreviation for stop loss and take profit. So right here you see we entered the trade in this little circle. We said, okay, let's take a trade. This is our entry price right here, which is like 16, I want to say 16,450. Entered right here, and price hit our stop loss. So we incurred a loss. We lost $100 that we just put into the market. Now, if price would have went up and never hit this bottom level, which is right here, if price would have never hit the bottom of the stop loss, then we would have made $100. Let's see another example. This is an example of a Forex trade with a stop loss and take profit. This is going to be GBP USD, which is the British pound versus the US dollar. Now in this trade, we entered right here, and we had price actually go in the direction that we wanted to go. So we had that 100 pip stop loss, and we had that 100 pip take profit. Looks a little bit bigger. This one might actually be a 200 pip take profit because I went to this next level. But this is a perfect example of a trade going your way. And once the trade hit the take profit level, your trade was closed and you took profit. Review. Traders out to have a preferred plan for entering or exiting a trade before executing it. Effectively employing stop losses enables a trader to reduce both losses and unnecessary exits from a trade. So it's really important that when you set a stop loss or a take profit, if you have done the research and you are sure and certain of the trade, you should stay in the trade until it hits either your stop loss or your take profit. This will maximize your profit and minimize your loss. 4 key takeaways I want you guys to get from the information that we just learned. Number 1, I want you to know how to define risk tolerance. Clearly establish the level of risk you are willing to take on each trade, considering your overall financial goals and comfort with risk. Number 2, set stop loss orders. Utilize stop loss orders to limit potential losses on trades, ensuring that you exit positions if they move against your expectations. Number 3, position sizing. Determine the appropriate size for each trade based on your risk tolerance and account size. Avoid overcommitting to a single position. Don't over leverage your account. Don't go super crazy. Don't risk $90 in a $100 account. That's too much risk. Number 4, regularly review and adjust. Periodically review your risk management strategy in light of market conditions, your financial situation, and any changes in your risk tolerance. So basically, whenever you're thinking about risk, take profit, your account, or a trade, whenever you enter a trade, you must be comfortable and be willing to lose the amount that you have put at risk. For example, if you have a $1,000 account and you're risking $10, you must be comfortable with losing $10. Or if you're risking $100, you must be comfortable with losing $100. This will play key in the psychology of trading. It's very, very important to keep a good psychology. And we'll go over that later on theorangecompound.com. We'll have something put together for you guys there as well. If you guys have any questions, please reach out to us at theorangecompound.com. Follow us on Instagram at theorangecompound. And also, if you're watching this on YouTube, comment below your risk tolerance, how much you'd be willing to lose in a trade, and how much you'd be willing to get in a trade as far as take profit. If you guys have any more questions, please let us know. Thanks for watching.